Hi, this is Lakhi Singh, the property fixer, here to fix you and help you grow your property and your business affairs to the next level. So if you're looking for knowledge and insights about how to get involved in property, solve your problems about scalability in your property business, then do watch our 20-minute clips. We've taken them from hundreds and, well, thousands of videos that we've taken over the last 6 months, and we've broken them into simple chunks which can make them useful for you. So do watch and do subscribe to our YouTube channel underneath as well.
And you're right, sometimes the data is actually inaccurate, but it's incumbent on the person to monitor their file. It shouldn't really come as a surprise if you've got a CCJ, because if you're looking to buy in the next 6 months, 1 year, the first thing you need to really start off with is do your credit search and make sure that's clear, because there are mistakes. Mistakes do happen, as you rightly say. Brother with the same initials or whatever. We had a case last week where the person was deemed to be politically exposed. Their name, their name matched somebody in the Pakistan, political circles.
Excellent.
So, and the client said, I've never been to Pakistan. How the hell did this happen? So,
excellent.
So she had to go and tell them that she's not a politically exposed person and get that marker removed, because the lender surely would have picked it up and questioned it, because lenders don't.
Well, that's an interesting topic, Bob. Bob, you brought another interesting topic. What type of additional things are brought into your credit file? Because I remember there was a issue, and we'll go over to Lakhi Singh and ask him what he says about it. There was a time that your credit file was somewhat synced to you. It was your personal credit file, and it wasn't really supposed to be shared by the banks. But apparently, I think there's been a slight change in data protection, where the banks actually can see your credit file, and they can actually see all of the lending that you have in terms of, in particular, property lending, apart from credit cards. Is that true? Is this now opened up? The banks are able to look at your credit file.
With your authority, yes. So if you've opened a bank account, you've signed on the dotted line to say they can do a search whenever they feel like it.
If you a bank account, you're saying?
Yeah, if you've opened a bank account, you have signed up for them to do a credit search on you whenever you make an application, or whenever they feel like it.
The fact you've got a bank account that allows the bank to do a search on your credit file.
Yeah, read the terms and conditions.
Okay. No, there's actually a lot of the bank terms, I totally agree, have something that's called the power of attorney clause, but really there is a debate about that's challengeable, and that the power of attorney clause can only be regarded as true and valid if it is enacted and also registered in the Department of, the Department of Protection. Is that right?
Probate registry.
Yeah. Okay. So what you're saying is, effectively, if you've got a bank account, the banks can check your entire credit file. Is that right?
It is. And obviously, with technology now moving fast forward, you've got open banking coming in as well. So banks can see across all the banks and see what accounts you've got.
Excelente. So the only thing that's really personal to you now, Bob, is the underwear and the choice that you have in the morning.
Or the long
Is that
johns.
right?
Or the
long johns. Yeah, we know the secret now. Yes. Lakhi Singh, talking to long johns. Do you wear long johns?
No, I don't.
You don't what?
Slightly personal question.
You don't fancy them, you say? What did you say? We didn't say whether you fancy them. We said, do you wear them?
He said he doesn't wear any.
You don't wear any. Okay, everyone knows now it's all free movement. I like that. Okay.
Commando
Scottish culture.
Another secret, the Lakhi Singh success, and it's free, born free, like the lion in The Lion King, Simba, like that. Okay, so Lakhi Singh, with the fact that you are free thinking, What's your take on credit file? Because I think there was an issue once it first opened up. A lot of the clients were being told that their credit file was being checked and they weren't aware of it. And what Bob says, technically, the fact that you got an account means they can check your credit file. So there's no real restriction to the banks. But what does that say for data protection? Because data protection is slightly different now, isn't it?
I think the worrying thought, this is the point that we may need to touch upon today anyway, is that when we're talking about negative equity or people with large portfolios, what's been happening, Bob, is in our experience, I think it's about 10 years ago, when we started litigating on behalf of certain clients to deal with shortfall matters when the property's been sold. The banks, what they were doing is going to the credit file of the buy-to-let client and then checking out what other properties they've got to try and see what collateral they've got so they could go after the collateral. And then and using the knowledge they've got about the client, obviously, I suppose for them it's open information, to then decide really how they're going to secure their debt. And I think a lot of the clients were taken by surprise when they had some sort of court order to try and take them to court to try and take charges over additional assets. I think something along those lines. And I think a lot of clients aren't aware that banks have complete access to everything that's going on.
Okay, this goes back to negative equity as well, isn't it? We had a conversation. That's the underlying topic. The real worrying thing is, and I think we were talking, was it Ninda? Was it Bob? I can't remember. We were talking about the fact that debt provisioning. So in the back office, the banks write the debt down. So really, where you owe them $1 million, you actually only owe them $500,000, but they're still chasing you for the $4 million. So they're relying upon a contract, even though in accounting terms, they've written the debt down. When they get, say, 600,000 off you, they technically are showing £100,000 profit. Why is it so draconian? Why is it always set against it? And how do people then write off negative debt, Lakhi? What is unique about your solution in assisting people to write off the negative debt? Are you talking to the banks directly and negotiating with their accountants the writing down of that debt so that they can walk away with a clean bill of health, the deed of settlement, as you used the terminology a few weeks ago, which is like saying full and final settlement? Before we continue, I'm going to ask, is it, let me just find out. Mr. Vikram says the Three Musketeers of property are talking about the Don, and I believe when they're talking about the Don, they're talking about Lakhi Singh, the property fixer. We didn't have, obviously, Mr. Trump on. So, yeah, so he says the three of us talking about the Don, talking about Lakhi Singh, the property fixer, the Don. So, yeah, Lakhi Singh, tell me, what is it you're doing? Are you talking to the banks directly and telling them, hey, guys, can you write down this debt? You've already written it off your debt ledger. Obviously, it's only now $500,000. Can we please get the benefit to our client? Is that what you're doing?
It's not quite as simple as that. What we have to do is I can't really be involved in that process. It's a sort of regulated process through an IVA. But you can sort of say the process does that in a different way, which is that it forces the bank to work on the client's behalf for a change rather than on the bank's behalf. So whether it's, I don't think it's, how it impacts debt provisioning, I don't know how that would work. But I know that the results we've achieved in terms of negotiating the debt based upon the IVA and how that's structured, has meant that over 500 buy-to-let clients who've had negative equity problems have benefited from this solution. So getting a deed of settlement, getting it written off works, but the mechanics are not something that we would sort of divulge to the public, because it's a process that's carried out in a very regulated and regulatory administration within the confines of a lot of legislation as well. So everything's done at a very professional level using all the right tools.
Yeah.
So what we do, which is a bit different from anybody, is that we do a stress test or an initial called an asset appraisal, which determines to us really what's the likelihood of success. And if we think that it's not going to be successful for whatever reason, then we tell the client accordingly. And if they still want to proceed, then there's never any misunderstanding, because there's always clarity in the beginning of the process is more important than halfway through, when there may be some sort of potential inability to help them to achieve their result. Okay,
just hold that thought there. Got a hello, Howard, from a Vikram as well, and from Maxine. Both say hi, and Imran as well. I think Imran as well says hi to everyone. Okay, Bob, you're doing similar things, obviously, in the regulated world. So you go through a risk assessment or you go through an asset and liability sheet. Are you finding people are somewhat in their own position looking to try and get at the negative equity trap by trying to refinance their other assets to pay down the loan to values, or raise money to pay the shortfall in a sale of a property that they've realized was negatively geared? Have you had this problem on the residential side, or at least on regulated mortgages, but people trying to pay off their debts in releasing equity from their properties?
We don't see negative equity as much as maybe Lakhi does in the regulated world, because the whole purpose of regulation is to make sure your mortgage is affordable, for the next 15, 20 years, because new mortgages are stressed at 7% interest rate, whereas you're actually paying 2%. So, negative equity isn't going to affect most people on the regulated side, because firstly, they put down a deposit, and secondly, the market's been pretty good for the last 15, 20 years here. So I see that a lot less here, to be honest with you. But I have seen it in portfolios, I think, which is where obviously I think Lakhi sees it as well. People who maybe have bought properties in the north of England, I've seen certainly a lot of negative equity situations in Sheffield and Hull, and those sort of areas. But what can you do, apart from going down the Lakhi route and, doing a bit of an arrangement? The other way is to, as you rightly say, restructure the whole portfolio, release money from where you can to reduce the debt on the one that you are in negative equity on, so that so you do build in some sort of equity, because certainly on the buy-to-let scene, and anybody who has more than 3 properties is termed a portfolio landlord. And then the whole portfolio is stressed. They look at the whole portfolio. So even if there's one property that's not performing, it's likely to bring down the whole portfolio, because they want all the portfolio to be performing. And even if one property is in negative equity, the whole plan fails. So we have to address those issues before we take that case to a bank.
Okay, so with those announcements, I think we spoke about it last time, but we didn't get our teeth into the topic. About 1 million, I think, plus homeowners that were sitting on an interest-only mortgage without a payment vehicle. We spoke to, I think it was yourself we spoke to, about the endowment policy and the fact that it failed, etc., etc. But tell me, how are those people going to be assisted? Is there an assistance package out there for people who are going to find when the interest rates do go up, that they have some fallback position? Will the government give them some type of reprieve, or will they be given payment holidays? How are they going to manage even a mortgage that's going to become unaffordable?
Yeah.
I remember a lot of these people went up a ladder, didn't they? They left their 2 bedrooms for 3, and 3 for 4, and 4 for 5, and 5 for a mansion or whatever, and they took out larger mortgages, and they took them out in interest, expecting the endowment or the vehicle to pay for the difference in the end of term. But because that's collapsed, so what advice have you got for those people who are sitting on mortgages that are going to become unaffordable? What do they do?
I think they need to take action rather swiftly, because time doesn't stop. Even if you've had warning letters from the bank telling you your mortgage is due to be repaid, most people still ignore them. They think they're sort of immune from any action that the bank could take. The FCA has directed the banks to be considerate and understanding. The last thing the bank wants is really to force a sale, but they will give you every option to address your issue. Endowment claims are now closed. You can't claim against a missold endowment.
Exactly. Yeah.
So, if you've still got that endowment, yes, you could cash it in. You could bring down the balance, of course. But you should be really assessing what your options are, because if genuinely you can't move, genuinely you can't sell, genuinely you have no other assets to bring down or pay off that loan, there is going to come a time when the bank is going to say, okay, enough is enough. We've given you time to sell. We've given you time to sort things out. Even though the mortgage is, sort of finished, we want our money back. So,
right. So you tell me, in that situation, how long does a bank normally give you then, if it's a residential mortgage?
I mean,
how long will the bank?
I have done some of these cases where we have actually successfully extended their mortgage. So rather than try and pay it back, we've negotiated an extension of say 5 years to the actual term, which has given them a bit of a breathing space and plan ahead.
Yes.
But if you're already age 70 and you've come to the end of your mortgage, the bank will give you maybe 1 year, 18 months to try and sell beyond that point. But there will come a time, unless legislation comes in, unless you've got the income in the background or the pensions in the background to take out either a retirement interest only mortgage, which is based on your pension income, or you've got the last resort of an equity release mortgage. If
you spoke about them last time, equity release. So I think, is it 55 plus, and they do a calculation based upon how many years they think you're going to be on the planet.
Absolutely.
Based upon that, they give you a percentage release from the equity. And can that be from properties that have mortgages on them, or has it got to be only properties that are incumbent or unincumbent? Sorry.
Yeah, it can be both. I mean, it all depends on the loan to value, and as you rightly said, how old you are and how long you're expected to live. So your health comes into play when they sort of look at these things. So, but they don't lend big money because they know that that debt will be there for the next 20, 30 years, possibly, accruing interest at, say, 4 or 5% a year. And so they don't lend big loan to values. But so this will only work if you're, for example, 20% geared or 25% geared as a 60, 65-year-old. They want that.
It's only going to work if you've got a low loan to value, and you pay off the loan to value, you pay off the mortgage that's existent, you technically get a lifetime mortgage at a very reasonable rate. Is that right?
Yeah. The rates are around the 4 or 5% level at the moment, depending on your equity situation. So it's no longer easy. It's a regulated field. I mean, we're not licensed to advise on equity release, but I'm doing my exams. But certainly, you need to talk to an expert who can guide you properly on this. But that is probably the last resort, because what you're doing